are you going to lose in the trade? How many years is it going to take you? Let's just swag a difference. Let's say it's a 1% difference in return. How many years would it take to pay the tax bill and get you back to break even? So, and also, do you have confidence in the new recommendation? Have you done your homework? Have you gone and studied it? And I think we have a lot of confidence in DFA as an investment provider. So I would imagine a lot of our listeners do too. But you really should invest in things that you've built your own confidence in, that you can stick with for the long term, that you think is going to serve you well, and prudently consider the changes, that the costs of making those changes. So I always hope that people won't just willy-nilly snap and automatically follow, that they will take a moment and think about it first. A couple other questions that will be on the article. Will we be updating the ETF custom allocation calculator? We've had an ETF custom allocation calculator for a long time, but the portfolio configurator really replaces it and is better. And so I'm not going to be updating it. The good news is you can go in and change that fund on your own. And if you've been using it to use it, you had to make a copy to your Google Drive account, you'll still have access to it. So I think most people will be better served by the portfolio configurator. And I'll just, since that's there, I'll just pull it up really quickly. This is what it's going to look like. This is with the new allocations. So if I go ultimate buy and hold and pick, we'll go tax deferred and use the best in class ETFs, you'll see that it's got the new recommendation DFIV in there. And if we go back to ultimate buy and hold and look at all of the portfolios, you can see how they line up and you can compare them, and you can look and see that the best in class is the smallest and the most value-y. These are both best in class, taxable and tax deferred. And then you get Vanguard up here and Schwab. And so you can go and look and you can compare and see how they did. There is a change here. I changed how I calculate the average market cap to align with the way Morningstar does. They use a geometric mean. So you can read about that in the glossary on page 2. But without getting us into the weeds, this will be available, and I think it'll provide useful information. So
that's great. Thank you, by the way, for that, Chris. That's a great tool.
I think it's working out pretty well. Another question that comes up a lot, what if I don't have access to all the funds? There's a little story here that kind of walks you through what somebody with a really limited selection would have. But the gist of it is you kind of want to think about what your priorities are. Do you value size most, or value most, or geography most? Those are sort of the 3 dimensions on which these portfolios are calculated. And then you just start substituting and figuring out how to fill the gaps in a way that respects your first priority, and then your second priority, and your third priority. So it's art. It's really art.
Why don't you remind them just at this moment what your 3 priorities are, so that they will be reminded how they might be most productive themselves.
If it was me, I probably would I would prioritize value first, size second, and geography third. That if it was me, that's the way I would do it, because the premiums kind of lay out in that order. There really isn't much of a premium for international. We do expect emerging markets, because they're more volatile, to have a higher return sometime. You don't know when, but sometime. So there's a little bit of a return boost for that, but there's really not an expected premium for international versus US. And
that's
the premium.
A big deal. What you just said, Chris, is a really big deal, because this is a struggle people have. Now, do I have to have international to get the value? You said number 1 is value, to get the value. Number 2, can I get the size in the US? Do I need international for size? No, you don't. And then number 3, you get this. Yes, you get this diversification, but in essence, the diversification that is there has has more to do with the value of currencies. And so you can have a period where the dollar, for example, is real weak. It's been really strong for some time, but it could be very weak, in which case those international currencies will make the holdings in those international funds more profitable. But it isn't about growth. It's about a currency change.
The way I look at internationals is that they're an insurance policy against something catastrophic happening in the U.S. You know, knock on wood, we're gonna keep the hopes alive that won't happen. But history is replete. It's full of examples of where catastrophic things happen that are unexpected. And so if you have everything in the US, even though those companies have a large international presence, if something systematic happens wrong with the country and its property rights, then that international doesn't protect you very much. And again, it's extremely unlikely, but if you had some international in that situation, then it would provide some level of insurance or protection against that one catastrophic point of failure, so to speak. So I view the international as a prudent hedge against that one concentrated risk. Yeah.
And to be fair there, that comes at an extra cost.
It does.
It comes a little bit of tax cost in some cases, and also
a little bit of higher expense ratio sometimes.
Yep. And also same liquidity. Yeah.
It also comes with a little bit of a discount in a way, though, too, because the U.S. market is so widely respected for its good property rights and its historical good returns and safety and regulatory environment. People pay a premium. You pay a higher price to earnings multiple and price to book multiple.
Yep. Yeah. Very good point.
Yeah. Let's see. So the last question, why don't we include all-in-one funds like AVGE and multi-factor funds like VFMF and target date funds? And part of it's just I only have so much time in the day. But part of it's that, we want to keep the message simple and actionable. So we have a set of portfolios. They require a set of assets, and we recommend funds for those assets. AVGE is a fine fund. It's an all-in-one global worldwide fund that tilts towards small in value, but we don't have a portfolio that uses an all-in-one fund. And it doesn't tilt quite as much as the ultimate buy and hold portfolio. So I have trouble recommending it instead of the ultimate buy and hold portfolio. Still a good fund. I don't have any problem with it. And VFMF is a multi-factor fund that actually looks a little bit like a large cap value fund. In fact, it has a little bit higher return per unit of risk than the fund that we recommend, but it's not a large cap value fund. It's got a higher level of active management in it. So there's not really a spot in our portfolios to recommend it, but that doesn't mean it's a bad fund. And people, I know people admire our work and thank us for our work and then go off and do their own thing. Yeah. So I mention this because I don't want people to think just because I didn't list it or didn't mention it that it's a bad fund. And then target date funds, limited selection. There's a lot of times people don't have a choice, and Vanguard's pretty widely available. So maybe someday, if I get a lot more bandwidth, I'll analyze target date funds. But for now, I think we do our back testing and analysis with a Vanguard-like allocation. And I think that's probably helpful to people. And if they don't have a Vanguard fund, the other one's going to have a lot of things in common with a Vanguard fund anyway.
Great.
Yeah. So I think that's it. It's relatively simple.
So in the coming weeks, we will have the investment calculator, the lifetime investment calculator, will be updated with new data. So we'll be able to, and we'll have the fine-tuning tables. You're going to have to give us maybe another month before all of this will be complete, but we're getting there. And but by the end of March, I think all of this information that we update on a regular basis, some of it annually, and as Chris has already mentioned, he looks at these every couple of years. It is an interesting question, Chris, and I have it about the work that my wife and I have gifted money to grandkids with the idea that they should leave it where it is, in essence, for the rest of their life. And how do you emotionally think about the idea of putting money away, whether it's in an Avantis fund or a DFA fund or a Vanguard fund? If it could be true to its asset class, can you see somebody actually owning that fund for the rest of their life, other than taking money out or adding some fixed income because the fund itself is too volatile? But how do you think about investing for the long term, and how does that fund differ from owning IBM stock or Google stock or Tesla?
Yeah, I think all of the best-in-class fund recommendations we have, I would be comfortable using as I'll call it, in some respects, a placeholder for that asset class for the long term, thinking that if the fund, a lot of times when funds close, they get subsumed by other funds that have similar management. You always want to be careful and look and see if it gets, passed into an asset class you're still happy with, or a management style that you're still happy with. But I would hope that these will last a very long time, probably not a lifetime, but that they'll last a long time. And then, somewhere along the way, somebody will evolve them into something similar. The difference, of course, between these and a stock is diversification. These all have hundreds, if not thousands, of stocks. And so you're not vulnerable to that idiosyncratic volatility and risk that comes along with just a single company. And that provides some safety with the same expected return that you get for the similar companies, assuming that they have similar financial attributes. Yeah.
I think the risk, in a sense, of being able to have it be a lifetime holding is, and I think this happened to some of the Vanguard funds. They attracted so much money that they, and I don't know this for a fact, but it appears to be this way, that they ended up owning a larger average size company. And it may be that what one would want to do in 30 years, let's say, for example, the Avantis Small Cap Value Fund grows to where the average size is twice that. And this is true of Vanguard. They are 2 and 3 times bigger companies than you get in other small cap value funds. But if you've learned your lessons well, and Chris, I think you're doing a great job of teaching, you will know how to identify the ETF, if that's the way that they're presented to investors 30 years from now. But you'll know how to evaluate those funds that do, in fact, have smaller companies, maybe more deeply discounted. And that's part of the process that we hope that our work is going to help. And there's a desire to figure out how do we continue to give you this information, particularly those of you in your 20s, when Chris and I are no longer even around to give you these recommendations. But I just want you to know we're working on that, because I think this kind of work, particularly if it can remain free to people, and help them on their own build a portfolio that is just as good as anybody you might have paid 1% to, or some actively managed fund. That's why we're here, and that's how we're trying to help. And I hope you'll choose this presentation as one you share with your friends about the work that we do. Because again, this is work that could be used without any of our portfolios. Just to know that these are great ETFs. And Chris, thank you so much for taking the time to do all this work. It's valuable. Thank you.
Well, it's always a learning process too. So I enjoy that part of it, and I enjoy the questions that come from our listeners. I learn a lot from the challenges that come our way. I've learned about leveraged funds. I've learned about commodity funds. I've learned about negative momentum in small cap value. I've learned about a lot of good things from our listeners, and I appreciate that. So keep them coming.
All right. Good luck to all of you, and we'll see you next week.
Paul Merriman with Sound Investing. Sound Investing, soundinvesting.com, and paulmerriman.com are produced and exclusively owned by Paul Merriman, who is solely responsible for their content. For more information, free articles, mutual fund recommendations, and more, visit paulmerriman.com.